On August 15, 1971, the architecture of global commerce underwent a transformation so fundamental that its consequences continue to compound through every market, every currency, and every asset price visible today. When the convertibility between dollars and gold was severed, what replaced it was not simply another monetary system, but rather a framework built entirely on confidence, on the presumption that paper instruments could indefinitely represent value without the constraint of physical settlement. What most observers failed to recognize in that moment was not the policy decision itself, but the structural mutation it introduced into how markets would function for the next 5 decades. The mechanism was elegant in its simplicity and devastating in its implications. If currency could be created without reference to tangible reserves, then price discovery would no longer reflect scarcity, but rather the oscillation between confidence and doubt within a closed system of leverage. The pattern visible in February 2026 across silver markets is not new. It is the identical sequence that preceded the collapse of bimetallic standards in the 1870s, the liquidation spirals during the Great Depression's commodity washouts, and the violent dislocations when the Hunt brothers attempted to corner silver in 1980. In each instance, the surface narrative focused on speculators, on irrational exuberance, on regulatory intervention. But beneath every episode was the same structural contradiction. Physical commodities exist in finite quantities. Financial instruments referencing those commodities do not. When the volume of claims exceeds the volume of deliverable metal by orders of magnitude, the system functions smoothly only as long as redemption requests remain dispersed and modest. The moment a significant portion of claim holders simultaneously demands physical settlement, the mechanism seizes. What occurred across global silver markets during the first week of February was a stress test that revealed the depth of this fracture. Prices initially declined with unusual velocity, triggering liquidations across leveraged positions and creating the appearance of abundant supply. Yet within 48 hours, the rebound arrived with equal force, accompanied by something far more revealing than the price movement itself. Physical premiums widened, delivery delays extended, regional pricing diverged in ways that arbitrage should have immediately corrected but did not. The Shanghai premium over Western spot prices expanded beyond levels that rational market mechanics could sustain, suggesting that the flow of metal between jurisdictions had encountered impediments more substantial than logistics or transaction costs. When arbitrage fails to close a gap that should be profitable and obvious, the explanation is not inefficiency. The explanation is that the underlying asset is not moving because it cannot move, or because those who hold it have concluded that the paper price no longer represents its actual worth. This divergence between paper pricing and physical availability is not confined to silver. Gold markets have exhibited similar symptoms intermittently since 2008, particularly during moments when central bank balance sheets expanded rapidly or when geopolitical tensions disrupted settlement chains. The London Bullion Market Association and the New York Commodities Exchange operate on the assumption that physical delivery requests will remain a small fraction of total trading volume. The entire infrastructure is designed around that assumption. Vaults hold reserves sufficient to satisfy normal redemption rates, not stressed redemption rates. Refineries operate at capacities calibrated to predictable demand, not panic demand. Transportation and insurance networks function efficiently under stable conditions, but become bottlenecks under volatility. The system was never constructed to handle simultaneous redemption across multiple geographies by multiple classes of buyers. It was constructed to handle the opposite, to facilitate endless rolling of contracts, endless speculation on price direction, endless creation of synthetic exposure without the burden of physical custody. The significance of the China premium extends beyond simple supply and demand mechanics. When a major economy consistently pays above global reference prices for a commodity, it signals either inefficiency or strategic intent. Inefficiency at this scale and duration is implausible. Strategic intent implies accumulation that exceeds publicly disclosed reserves, accumulation designed to position the holder advantageously in a future scenario where physical possession matters more than financial claims. The precedent for this behavior is well documented. During the 1960s, France under Charles de Gaulle systematically converted dollar reserves into gold, recognizing that the Bretton Woods system was issuing claims far beyond its ability to settle. The redemptions accelerated until the system collapsed. The mechanism today is more complex, but the incentive structure is identical. Any nation observing the expansion of dollar-denominated debt, the proliferation of financial instruments detached from productive capacity, and the concentration of monetary creation in a shrinking number of jurisdictions has reason to question whether those claims will retain purchasing power indefinitely. The behavioral response among retail buyers during the recent volatility provides another data point that conflicts with the narrative of abundant supply. Dealer inventories depleted rapidly. Mints reported surges in orders. Online platforms experienced traffic levels that overwhelmed their infrastructure. This is not the behavior of a market where sellers dominate. This is the behavior of a market where buyers interpret price declines as opportunity rather than warning. The distinction matters because it reveals something about collective psychology that price charts cannot capture. When a large cohort of participants views weakness as a buying signal rather than a liquidation signal, it establishes a form of support that is not visible in technical analysis, but becomes operationally significant during subsequent sell-offs. Each wave of forced liquidation gets absorbed more quickly, each recovery becomes sharper, each attempt to reset prices lower meets incrementally stronger resistance. The role of private credit markets in this environment introduces a variable that has not been fully tested under conditions of genuine stress. During the era of near-zero interest rates, capital flowed into strategies that assumed perpetual refinancing, perpetual growth, and perpetual liquidity. Lending structures were built on valuations that reflected optimism rather than cash flow. Covenant-light loans proliferated. Leverage ratios expanded. The entire architecture presumed that the future would resemble the recent past, that disruption would remain manageable, that technological advancement would create growth sufficient to service obligations incurred during the borrowing phase. But assumptions do not dictate outcomes. When interest rates rise and growth slows, the cash flows required to service legacy debt do not materialize. When artificial intelligence begins to compress margins in software and services, the business models that justified high multiples deteriorate. When lenders begin recognizing losses, confidence contracts, and the cascade begins. Part 2. The connection between private credit stress and precious metals pricing is not linear, but it is structural. Capital does not disappear during dislocations. It relocates. It searches for assets that are not contingent on another party's promise, that do not require a functioning credit system to retain value, that cannot be diluted by policy decisions made in closed meetings. Historically, gold and silver have functioned as that destination during periods when confidence in paper instruments erodes. The pattern is consistent across the collapse of the continental currency during the American Revolution, the hyperinflation in Weimar Germany, the currency crises in Latin America during the 1980s, and the sovereign debt dislocations in Europe during the 2010s. In every instance, the initial phase involves denial, the belief that the system can be stabilized through intervention, that liquidity can be restored through monetary expansion, that confidence can be manufactured through communication. In every instance, the denial phase ends when the scale of the problem becomes undeniable, and the flight to tangible assets accelerates beyond the capacity of authorities to control. What makes the current moment particularly unstable is the simultaneity of pressures. Currency debasement is occurring not in isolation but alongside technological disruption, demographic inversion, and geopolitical fragmentation. Central banks that expanded their balance sheets to unprecedented levels during the pandemic era now face the choice between allowing deflation in asset prices or accepting inflation in consumer prices. Both outcomes carry political and economic consequences that no major economy is prepared to absorb. The middle path, the controlled unwind, the soft landing requires a level of precision and coordination that has never been achieved historically under comparable conditions. The probability that this time will be different is not zero, but the structural precedent suggests that the probability is low. The mechanics of a disorderly repricing in credit markets would unfold predictably. Default rates rise. Lenders mark down portfolios, redemptions accelerate in funds holding illiquid positions, forced selling creates price spirals, collateral values decline below loan balances, margin calls proliferate, liquidity evaporates precisely when it is most needed. In past cycles, central banks intervened by purchasing distressed assets or providing emergency lending facilities. But intervention capacity is not infinite. Balance sheets are already extended. Political tolerance for bailouts has diminished. Inflation remains elevated enough that aggressive monetary accommodation risks destabilizing currency credibility. The options available to policymakers are narrower than they were in 2008 or 2020. The scale of the problem may be larger. If the repricing begins in private credit and spreads into public markets, the behavioral shift among investors would mirror historical patterns. Speculative assets decline first and most severely. Dividend-paying equities decline but less dramatically. Government bonds experience volatile flows as investors oscillate between deflation hedges and inflation fears. Commodities initially decline alongside everything else as leveraged positions liquidate indiscriminately. But in the later phase, as the nature of the crisis becomes clear, physical commodities decouple. Gold rises, silver rises, industrial metals stabilize, agricultural products reflect supply constraints. The repricing is not driven by speculation, but by recognition that paper claims have become unreliable. The question facing participants in precious metals markets is not whether another wave of volatility will arrive, but whether the next wave will behave like the previous ones, or whether something fundamental has shifted. The evidence from physical premiums, regional pricing divergence, and demand behavior during recent declines suggests that the relationship between paper and physical markets is under strain. If that strain intensifies, the consequences extend beyond price charts. Exchanges may restrict delivery, refineries may ration capacity, governments may impose export controls. The fantasy that metal can be obtained at spot price on demand would dissolve. The two-tier pricing structure that has existed informally in certain jurisdictions would formalize globally. Those holding paper claims would discover that conversion into physical is no longer straightforward. Those holding physical would discover that their position is no longer fungible with financial proxies. The historical record offers no example of a major monetary system transitioning smoothly from one regime to another. The transitions are marked by volatility, by wealth transfers from creditors to debtors, by political upheaval, by policy improvisation that creates unintended consequences. The transition from the gold standard to Bretton Woods involved depression and World War. The transition from Bretton Woods to the current dollar system involves stagflation and the near collapse of major financial institutions. The presumption that the next transition will be orderly contradicts every precedent. What remains uncertain is not whether stress will materialize, but whether the institutions responsible for managing that stress possess the credibility, the coordination, and the tools to prevent cascading failures. The belief that central banks can perpetually expand balance sheets without consequence, that governments can indefinitely issue debt without constraint, that financial engineering can substitute for productive capacity, and that confidence can be sustained through communication alone has been tested repeatedly across history. In every prior instance, the belief eventually collided with reality. The collision produced dislocations that required years or decades to resolve. The mechanism through which the collision occurs varies, but the underlying cause is always identical. Systems built on expanding claims eventually encounter limits. Those limits can be deferred, but not eliminated. The deferral creates the illusion of stability while accumulating the pressure that ensures the eventual adjustment will be more severe than it would have been had the correction occurred earlier. What the silver market demonstrated during the first week of February was not simply price volatility, but the fragility of the mechanism that connects paper pricing to physical reality. The rebound was sharp, the premiums widened, the demand materialized despite the decline. These are not the characteristics of a market where confidence in paper claims remains unshaken. These are the characteristics of a market where participants are beginning to distinguish between holding a contract and holding the asset. If that distinction spreads, if it deepens, if it becomes the dominant consideration among a critical mass of buyers, then the repricing will not be a correction. It will be a recognition that the previous pricing was never sustainable. The system is capable of functioning under stress, but only if the stress remains contained. Once the stress becomes systemic, once it spreads across asset classes and jurisdictions simultaneously, the assumptions that underpin normal market operations cease to apply. What follows is not prediction but pattern recognition. The pattern has repeated, the incentives remain unchanged, the mechanisms are under strain. Whether reform arrives before rupture remains the only variable still subject to human decision.